All right. Welcome back to another episode of the Real Estate Investing Club. Today we have Nic DeAngelo with us from down there in sunny California. A little bit jealous right now because it's Seattle's doing Seattle things. It's nice and cloudy out here, but we don't complain because we like Seattle nice and green. So I'm super excited because Nic has a lot of experience in the industrial side of things. We were talking before we got on the show. He's boasting a 35% IRR, which just blows my mind. So I'm super excited about this, Nic. Thank you very much for hopping on the show.
Great to be here, Gabe. Great to catch up with you beforehand and talk shop a little bit. And I'm excited to dive in on some fun stuff today.
Cool. I told you before we got on here, we like to start with stories. So why don't you go back to the beginning of your story? How'd you get started in real estate?
So I've had real estate close to my heart for many years. I'd like to say that there was like this exact moment, but the reality is I come from a family of immigrants to the US and entrepreneurs, very lowly educated, uneducated. So they went towards merchant industries. Many of them built businesses up and sold businesses. And so I'm the generation that saw that generation sell those businesses, and what do they do with the money? Some were very successful, some were not. And what I saw was individuals that sold the businesses and invested, particularly in real estate, were the most successful. So I'm sitting there staring at this. I'm hardworking. I've been working since 12. I started with a lot of really bad jobs that I don't wish on anybody, and construction and masonry and really just backbreaking work. And I was like, these guys in real estate have something figured out. Being an entrepreneur, thinking ahead, being strategic. So I wanted to do that, and I saw that. And so instead of doing taking the long road, I went straight to real estate and begged and pleaded and worked for free for family offices and high net worths out of the gate. That were small enough that they're like, look, kid, we have nothing to hire or train or do any of this. I said, just tell me where you need me. And I had to literally, negotiate my way in to work for free. And what they ended up doing was saying, look, we don't have a place for you, but if you find deals for us, we'll look at the deals. And I said, fair enough. What are these numbers that you're looking for? And the only skill that I can own as an absolute best in class skill for me personally is I'm extremely able to find the things and navigate the things to get where I need to go information wise. So I'm very resourceful in that regard. And all I did was apply that single skill to find deals, find the best mentors, find the best strategies to buy in the market that I was in. So I started buying a ton of distress and calling banks and cold calling and finding people that had things they needed to get rid of at discounts. So all I did was be really resourceful because I was broke and starving and had nothing else to do at all the time in the world. And I found the best mentors to teach the best methods to invest. And I brought those deals to these guys, and the deals were really successful, but they were too successful. So what ended up happening was we bought too many deals, and groups that thought they wanted to be big landlords were like, whoa, this is too many. This is too many assets. So what we ended up doing, I sat down with our investors and said, hey, look, do you want help with this? Where do you want to go? And they said, we want you to handle the asset management also. So now Saint grew from acquisitions to also asset management. So that was really the start of Saint Investment Group, was in acquisitions at the Genesis, and then moving over to asset management. And since then, we also started taking outside investment. We've done 19 deals, like you said, with an average IRR of 35.5% updated last week. It is great. I was brought a tear to my eye. A lot of hard work, a team that's grown significantly, a lot of amazing investors. And so that's kind of the background of what got us to where we're at today. In our income fund, which is kind of our new jump off now.
Cool, man. I love it. And I love to hear, when people grow up in the environment where they see people around them, family, friends who are investing, you get that bug and you just take it by the horns and run with it. It's cool that you got started in kind of acquisitions, going out there, finding deals. most people when they get started, on the acquisition side, they do mailers, cold calls, that kind of stuff. It sounds like you started calling banks. That is, in my opinion, that's pretty unique. What kind of taught you that you should be calling banks, and what assets does it work to be calling banks looking for debt that they want, or assets that they want to take off their books?
I love this book. So we're in a semi-distressed market today. A lot of things have changed, right? There's lots of ups, lots of downs. The high rate environment has changed how we evaluate deals. It's changed what deals have longevity. It's completely changed the landscape with some economists, big names that you and I know, and the audience knows, BlackRock, Pershing Square, Bill Ackman, Howard Marks. These guys are projecting 1 to 2 decades of high rates, right?
Really? I didn't know that.
Pretty crazy stuff. But I started in 2008. So if you wanted to say the worst timing of all time, that's
when I graduated too. And I remember all the articles. They're like, people who graduated 2008, they're never going to make it out. They're going to be poor for their lives. It's like, that's just the worst time to be, into the job market.
Yeah. And you're doing deals and I'm doing deals now, right? We made it, we survived, but yeah, it was freaking brutal. And you remember that. Some people don't. But I was all in on real estate before that, but really my acquisitions started in 2008. So it was like the worst timing physically possible, but it was great in one way. Because usually, as you know, on the syndication or investment side, there's either a lot of money and the deals are kind of overpriced, or there's amazing deals, but nobody wants to invest because they're scared, right? It's that rough, seesaw of the market. So in 2008, I was begging and pleading and negotiating, basically bartering my way and basically almost bribing and paying the family offices that I was trying to get in with lists of investors that I pulled and scraped and put together from real estate clubs and all kinds of things like that. And so when they said, go find deals, I had the money all of a sudden, right? So the hardest thing in that market was the money, and I found it. But they didn't have deals. They said, look, we are up to our eyeballs just managing assets and doing this. So I went to work and I found the best route that I knew how on the distress side was foreclosures, right? That market was a bloodbath. So I was ramping up on the foreclosure side, and we were.
And were you calling foreclosures on the residential side or commercial?
So I approached them with residential deals and spent a lot of time, and they're like, what the hell is this? We have how many do you want us to do 10,000 deals? Like, how do we ramp this up? They had too much money and not enough time. Right. So I said, well, what do you need? What do you need to do? They said, add zeros. So I said, well, you have to go commercial. So we ramped up a lot. Some weeks we were buying 10 million in cash with cashier's checks in my pocket at the courthouse steps, bidding on deals, buying deals. And I was a young guy. So every time I held the checks, I was peeing in my pants a little bit. You know what I mean? And what ended up happening was we started getting a lot of attention from the banks we were bidding from. Again, I was very young, so that was a very I had a lot of attention on me. There's a small group that were doing this, very small crowd. It's a handful of guys in Southern California and the Southwest. So me being the youngest, it was like a neon sign. I got in with banks. I started seeing which banks, which lenders were doing different deals, after connecting with them, I said, hey, look, why don't we just keep in touch? Because we're buyers and you're sellers. So why don't we have a direct connection on certain things? And they said, well, the best way to do that is for you to buy them mortgages, for you to buy them mortgage notes that are in default. I was like, oh, look, that's not our business. Okay, we're property guys. I don't even know how to explain this to my investors. There's no interest there. But so we started buying a lot of mortgage notes as part of this process. And over the years, we built these up. And we're like, these are fantastic assets. We know exactly how much we're going to make. The negotiation of loan modifications, we don't want the property back. We're happy just to make sure that the borrower wins, the person that's not making their payments. We'll structure the loan so that they're successful, right? And what we found was, again, we've done great on the property side, and we're very proud of that. But as this market has shifted, especially economics have shifted today, what that gave us an opportunity for was to pool these mortgages together. And we have over 500 in our fund today, our income fund, and pay a set return to investors with ridiculous flexibility. So whereas our previous funds might be 5 to 10 years or syndications, our current fund, we can return money in 90 days to investors, and they can still make 8% and essentially double their treasury returns or their bank CD returns, but with much longer stability, knowing they can pull their money out when they need it. And the bank's not just going to send them a check back and say, you're making 5, now you're making 3, right? Which, is subject to change at any time. Yeah. So that's been the shift for us, is our investors started telling us, hey, many of them got older. Hey, Nick, I'm 76 years old. Do you think I want to be in a deal for 7 years? Right? Can't sell him on that, right? He's making a lot of sense. So, but if I say, hey, you're only in this deal for a minimum of 12 months, and in any time you want after that, you can get your money back in 90 days. That appealed to what our investors were looking for. That's what they were asking for. So that's where we shifted.
Gotcha. Okay. And I'm sorry, I must have missed this at the very beginning, but did you say you were buying the defaulted debt for commercial or residential properties?
Both.
Okay.
So a lot of times, especially in the wake of 2008, and there was essentially infinite loans that they needed to get off their book in the residential space.
Yeah.
There were so many. I mean,
yeah. I've heard of this strategy. Yeah, I've heard. We've had a few guys on the show who go and buy debt on the residential side. I've never heard somebody doing it on the commercial side, which makes a lot of sense. I mean, it's the same concept, but
sure.
That's pretty interesting. So yeah, it sounds like your career really did a hockey stick once you got to that point. When it comes to, well, first, when you're calling these banks, how does that conversation go? Like, how do you start the conversation, and what are you telling them that you're looking for?
I love this. So when you're looking at property, to give the audience a comparison, when you're looking at property, there's amazing resources. There's CoStar, there's LoopNet. There's all these set places that you can go for properties to look at comps, to look at exactly what's available. So you or I, if we wanted a bad deal, we could go buy something on the market right now, right? We could call someone and say, we'll pay full price, exactly what you're asking. We know it's hit the market, and all these people have said no, that are off market, and that it's already hit the market. But that deal is ready. And if if you or I buy someone's deal, the day that transaction closes, the relationship parts ways. There's a seller and a buyer, and their transaction's complete on the day of the sale. That is not the situation with debt. That is not the situation, especially with residential debt. So that's where this changes, is because with residential debt, there's something called reputational risk. Okay. So if Wells Fargo, for instance, just one of the big banks that we've dealt with, if Wells Fargo originates a loan to an elderly grandmother, okay, and then that grandmother, that loan is purchased by another group, and day one, they foreclose on that grandmother and they throw her out on the street and treat that whole situation completely inappropriately, that actually goes back to Wells Fargo, not that little tiny investor that bought that. Because Wells Fargo is the big name that still will show up on the paperwork throughout the history of the loan, even though it's been sold. So the reputational risk.
So Wells Fargo is looking for people that they trust to treat the situation appropriately.
That's exactly right. Because if they don't trust the buyer, it can come back to blow up in their face. Wells Fargo, Chase, any of the big originators. So the debt market, whereas you or I could go on CoStar and buy deals today in real estate, in debt, it's relationship-based 9,000, right? It's relationship-based level 9,000. Everybody's got to trust each other in big ways. And part of negotiations sometimes is saying, hey, look, you won't initiate any of this or that or foreclosures or anything for this period of time, because the banks have to manage their risk on things. We hate foreclosures. That's absolutely, we sell them off before there's any foreclosure situation. That's our last resort. But many people have a business model of foreclosing, right? So that space, you said, how do I approach banks? Well, today it's all relationships. It's people we know very well. I work out in the mornings with bank CEOs. I go to dinner with bank VPs, heads of departments. They're people that are dear friends. I really enjoy them. A friend of mine, I was just having conversations with, yesterday morning on the same thing. We trade deals all the time. Now, where I started out was that I had a reputation because I was already buying. I had already earned, hey, we have the cash, we transact well, we're good partners on the purchase side. So by the time I call, I say, hey, we're the guy buying all your stuff at the courthouse steps. We're buying your foreclosures. They go, oh, okay, let me transfer you to blah, blah, blah. So really hard to get in, but once you're in, that friendship is extremely invaluable. And so you can transact together, but you got to transact like a respectful adult and not be a difficult buyer, right?
As is
Because
the case
those
in
relationships
everything,
will
right?
grow quickly. Yeah, exactly.
Okay, that makes a lot of sense. So let's talk about just the general economy, because I know, on the debt side, you guys put a lot of attention on where things are going, what's going to happen. Interest rates right now, actually, I don't know what they are. I think they're in 7 to 8%, but they've been fluctuating, so they're high. What do you see? How do you see the economy going in the next 2-3 years? And what do you think how do you see the interest rates moving? Just give me your general crystal ball on the outlook of America right now.
Yeah. So I'll give you two sides of the coin. The first is I want to be like 100% clear. I don't think I've been clear enough in the past. I am so bullish on America. It's insane. I am like, especially in the last handful of years, we went from being like, hey, there's a lot of changing no, like we've really pulled away from the pack, if anything else, by it's not even close how far ahead the US is. The biggest metrics that people are concerned of, things like debt to GDP ratio, hey, we should be talking about the US debt. But every other country, even the major other economies, are so much worse off than we are. So super bullish.
It's not good, but it's not. Yeah, it's never good when other countries are bad, but it is good that the United States is doing well. So I'm glad to hear that you have a favorable opinion of where we're going.
Completely, top to bottom. Not to say that there's not issues, but whatever issues we believe we have here, just compare to the other top 10 economies, and we're doing pretty dang good. Also, extremely bullish on real estate. So there's deals that were purchased poorly in the past. That's something different to me. But the real estate market today, I think there's huge opportunities for syndication, for funds, for buying over the next 12 to 18 months that potentially could be the best since 2008, 2009. I really do believe that. That said, on the economic side of the fence, what do I see and where do I make my analysis and bets? So we have an entire 90-minute webinar on the future of inflation. My bet is long-term on inflation. My bet, and we've been saying this for about a year, we're saying the fundamentals of the US market have completely shifted and really rebalanced to more historical averages, to a level where we see a structural inflation of 3 to 4% for the foreseeable future, right? So if we're seeing structural inflation 3 to 4% for the foreseeable future, maybe 10 plus years, I'm betting rates will be at the 5-6% range for the next decade plus.
Okay.
That's my bet, being in the debt space.
I've heard, I think it was somebody else on this podcast said that if you look historically, the average interest rate, I want to say he said like 6.5% or something like that. Like, we experienced the 3% interest rate. That's nowhere near average. It's not what you should expect. And so we should expect, the 6 to 6.5% range to be, what an interest rate is. That's accurate to what you're seeing?
Near dead on. It obviously the window that you're looking at, but the last 100 years or so is almost exactly 6%. So, okay. I hear these discussions. I'm positive you do too, Gabe, because you have a lot of really great guests on these discussions ongoing of when rates go back down, right? And you're like, wait, what's the driver of lower rates here? So that we're all because the reality, if we're talking norm, we're talking 6%, 5.5%, 6%, right? Depending on the window you're looking at historically. So if you're taking 5.5 to 6% over the last 100 years, why would rates go back down to 3 or 4%, right?
Yeah.
You could make the argument the Fed is going to do that and they're going to have some. I just don't see it. Say what you will about Jerome Powell and say what you will about the Federal Reserve, but he's been his biggest BS of all time was inflation is transitory. Because here we are 4 years, 3 years later, 4 years later, and we're still talking about it. We're still dealing with it. But since then, he's been very open, and he's literally saying up to the minute what's going. He's saying, look, if we see negative trends, we won't hesitate to raise rates. Right? The last time they kept rates the same, but if you look at there's CPI and PPI, Consumer Price Index, which is what we all think of as inflation. Us, the consumers, what's the index that we experience of pricing? Does it go up? Does it go down? Usually always goes up, right? And then there's PPI, producer price index. So that's what manufacturers, producers, people earlier in the supply chain, what index or what are they experiencing on pricing? PPI has been going up. So usually that's a leading indicator that CPI, what we all experience on our groceries, is going to go up as well. So I think there's many interesting drivers to that. I think the cheap money era is over. I gotta say, you know that, and you know this, since 2008, the Fed has been doing all kinds of quantitative easing, meaning manufacturing lower, rates on things, purchasing things to bring those rates down. I think that party's over, and I think we have to reach a real, actual economic balance, and I think that's 6% plus right now at rates.
And now we just got to get the sellers out there to realize that they're never going to get asking price that's a 3% interest.
Bingo.
But that'll come around one of these days. Awesome, man. I love everything you're saying. I appreciate you sharing your wisdom. I took a peek at the clock. It looks like we have run it down, so I do have to push us into the quick question round. Are you ready?
I'm ready.
Let's do it. It starts with books or any form of education. Give me 2 recommendations, one for general life wisdom and then one for real estate specific.
Okay, I love this. So for real estate specific, Gary Keller has a book from probably 20 years ago. I think it's called The Real Estate Millionaire Investor.
Mm-hmm.
And it's an older book, but for me, that's so close to my heart. I tore that book apart early on. I literally probably read that book 15 times. It is torn to shreds, highlighted, dog-tailed, all, dog-eared, all that. So that's, I started there. It's a book close to my heart. On the personal side, on like more philosophy and life, what always brings me back, I work a lot of hours, a lot of stress along the way. I'm reading a book right now by Seneca called The Shortness of Life.
Oh,
so
man.
that's
that's literally my favorite book. You're speaking of the
Is it really?
Yeah. It's a great book, and it's a great toilet book where you can just keep it next to the toilet and just pick it up, read, a couple paragraphs, get all those juices going, and then put it back down. So that's a great recommendation.
It recenters, and then on the dorky side, I focus a lot on game theory. So I'm reading a book right now called Thinking Strategically that I'm really enjoying.
Very cool. Good recommendations. I like that you said Seneca. That is a really good book. That and Meditations by Marcus Aurelius. They're just kind of bite-sized things that you can ingest, which I enjoy. All right, I'm going to move us on to the next question. This is for your younger self. So let's go back to the Nick, who was just picking up that phone the very first time, calling that first bank. Go back to him, look him in the eye, give him one piece of advice moving forward.
I would have brought in more people to partner with. I would have had more investors that I could share that with, because I didn't realize how valuable what we were doing is. And we've worked with a ton of investors that the more we worked with, the more value we realized we could bring. And so our investor base is huge, and we really enjoy that. It just would have been meeting more people, bringing more people in the fold. And if we knew what that run up of that market was, and we had some crystal ball, we could have helped. Just so many more people too, just a bigger scale.
Cool. I love it. All right. Next question is about the US. It's a big place, a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
Oh man, I love this question. Okay. For debt, I'm looking at tier 1, tier 2 cities. That's what we're looking at. So we're suburban tier 1 to tier 2 cities. I love the middle class for the debt side. I love owner occupied. And I think with 90% of mortgages being at 5% or below, I think that is the sweet spot for debt, is those people are so dialed in and so insulated from all these, all the scary things we just talked about. So I think.
Wait, sorry, you just said 90% of mortgages have an interest rate that is below 5%?
Correct. In the single family market, because they
kind of crazy.
They did this in the last handful of years. You got 3% rates bouncing around 4% rate. So when you talk about interest is this and this is that's a sliver of residential that's affected by that, because who else is going to sell if the rate's 4.1%, right?
Right.
Not me.
We have a one of our mobile home parks is an interest rate of 2.86%, and we've got offers on the park, but we're like, I mean, we can't
Can't
beat
afford
this.
to.
This is yeah. Uh,
Can't afford
that's
to.
interesting. That's a really interesting. But okay, sorry, I jumped into your question. Give me one single metro that you're most excited about investing in.
For industrial, it's Southern California. It's Southern California. There's port drivers. There's the Port of LA and the Port of Long Beach that bring in about 40% of imported goods in the US. So
Wow.
as we move from made in China to made in India, which is a huge transition we're seeing, that's extremely strategic. And then as we see made in Mexico, which is also happening, Southern California is positioned on the border. So you have these huge drivers into a small market. California as a state of, organizing itself is terrible, really bad things that they can't figure out at the state level. I like Southern California for industrial specifically.
Cool. Yeah, I love that. Makes a lot of sense. Next question is about finding deals. It all starts with getting in contact with the seller. What is your favorite way to find good deals?
Oh man, I'm going to give you a cheat answer. Okay. Relationships are the number one, is the absolute number one. That's not helpful for someone who doesn't have the relationships. So the second answer I'd say is digging layers deeper and finding the person to talk to get the deals. So if you're operating in a market, find the top brokers and do whatever you can to be close with them on the property side. If you are in the debt space, find the trade desk, find the people that are dealing with distressed debt and get in contact with them. Spend the hours on identifying exactly who it is and then just focus on that person. Don't try and climb the ladder. You might never get there.
Yeah, no, that makes a lot of sense. All right, moves us to the second to last question here. This is about lessons learned. Not every deal goes the way that we expect. Sometimes things come out of nowhere, and in those situations is when we learn the biggest lessons. So, what was a deal that kind of went sideways, and what was the biggest lesson you learned from that deal?
So in my acquisition days when we were full-time working, on a small group and purchasing things, we bought a deal that the pricing was phenomenal, pennies on the dollar for a 41,000 square foot mixed use building. So it had retail, it had office. This was a time when those weren't bad words. Okay. So it was a very successful time in the market for both those assets. It was directly across from a courthouse. So it had government drivers. It was on a busy street. The problem was I hadn't drilled down on the economics back then as much, right? I didn't understand drivers to economies. I didn't understand what drove different asset classes. So we got a fantastic deal, the best purchase price anyone in that market had gotten in a long time, right? We had local drivers, tons of cross traffic, high visibility, signalized intersection, and we had a freaking courthouse across the way. Like thousands of people a day, right? What could go wrong for a retail office center? What I found out was it was a declining market. It was tertiary and it was extremely difficult. And incomes had fallen off a cliff in that market and had really begun a descending spiral.
Yeah.
So that was the exact deal that I said, hey, we need to understand the economic drivers much more heavily for future deals. We pulled that deal off by basically hammering the phones for government agencies to pack them in to try and create synergy with the courthouse, which we did successfully. But it was a 5-year bloodbath struggle. Like when we sold that deal, I think nobody said a word and we had stiff drinks in our hands. You know what I mean? It was like, that was the celebration with a lot of quiet moments. But I learned a lot and I'll never back off the economics again and the drivers and really not understanding those.
Yeah, and I feel like that's a lesson that's been hammered home so many times on this podcast, and I even learned it very, very stiffly in my own career, is that you really need to understand the specific area that you're investing in, and I'm talking, I mean, the economy, and then also just the corner of that you're buying this property on. You need to know it. If you're not investing in your own market, there's so many things that you're not aware of. I have plenty, I have an example that I've shared many times on this podcast where I bought a property in a good metro, but that specific corner was a bad corner, and it turned out just to be more of a headache than I wanted. So yeah, great lesson. And I'm sure it's something that you guys are no longer, now it's in your underwriting. Now you understand the lesson, and so you're no longer replicating that in your current deals. So moves us to the last question, and this is for the listeners. You have given us a lot to think about. I'm sure people want to reach out, get in contact with you. Where can they find you, and what should they reach out to you for?
Absolutely. We do webinar series super regularly because I really like, this is a great conversation. I had a ton of fun. It's hard to break down a really complex topic in a short period of time. So we do really expanded webinars. We do 90-minute, 2-hour webinars on detailed topics. We do those monthly. So those are things that are investment strategies, economic strategies to invest, in better ways. And we post those at saintinvestment.com/resources. So all the videos that we put out, some are short form, some are very long form webinars, as well as they can get notified of upcoming webinars that we're going to do and ask questions live, jump into the slides live. So they're really cool. There's a lot of value and a lot of time that goes into those, where a lot of people have been very happy. Thousands, I think, 20,000 plus a year tune in with us. So it's really exciting.
Cool. So that is saintinvestment.com what'd you say, resources, /resources?
Yes, exactly. Awesome. Right.
I will put that link in the show notes. So if y'all want to reach out, if you want to get in on those webinars, just click the little more in the description. It'll pull down the full description, and in there you can find Nick's link. All right, man, that wraps it up. Thank you very much for hopping on the show.
Really enjoyed it, Gabe. Always great to connect with you, and stay warm in Seattle,
huh? Thank you. For everybody who's here with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions whatsoever, reach out to me, Gabe at therealestateinvestingclub.com. As always, if you want to support us, just give us a like, subscribe, share, all that jazz. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode.